Hey guys, welcome to the podcast. Today's Friday, July 12th. Stock market is closed, and little bit of green on the screen. The Dow Jones managed to eke out a 3-point rise with a rally just in the last few minutes of the day. The S&P have finished up about 5 points, and the NASDAQ have remained the strongest, up 22 points or 0.6% on the day. Interest rates, which were down some of the day, actually ended up rising and finishing higher on the day. So we're back above 2.6. And I think we talked about interest rates yesterday. And I want to clarify something, because in the podcast yesterday I mentioned that bonds looked interesting. And I don't want you to think that I'm saying that interest rates are going back down here and you should buy bonds and you're going to make a lot of money. What I'm saying is, if you're somebody that is looking for income in your account, you're looking for steady, reliable income. Obviously, when we were over here, bonds weren't that great of a deal. And now up here, they're a better deal than they were down here. And so this is not a time necessarily to go buy TLT. That's not what I'm pointing out. And TLT being the Treasury bond ETF. That's not what I'm pointing out. What I am saying, though, is that if you're somebody looking for income and you had something that was paying, let's say, 5% last week, there's a good chance it may be paying 6% this week, or let's say last month versus this month. So if, reinvesting some of that money you're not needing to take out into things that are paying a little more than they were a few weeks ago is not a bad idea. Now, we're still at an interesting area for interest rates in the bigger picture, because, until this trend is broken, which we're sitting right on it, interest rates may continue higher. And we're at a point right now where they tried to break through today, and they may do this, and they may zigzag down. I don't think we're in an economy that can withstand interest rates going up to 4%, and especially at this rate. I mean, they've been going up at a very fast rate. So for those of you wanting to buy treasuries, wait till this is at least broken. For those of you wanting to short treasuries, you think interest rates are going higher, this is the spot to do so, but you have to keep your stop beneath this line here, which is pretty close to where it is right now. So be careful about that, but we're in this trend. But the whole point of the story was yesterday is that this is a better place to buy bonds, and they're a little cheaper now than they were before. It's not to say you wouldn't potentially lose some money in the short run, but if you were looking to get some money invested in some income-producing things, there's a lot of them to choose from right now compared to 2 weeks ago, 3 weeks ago, or 2 months ago. So I just wanted to clarify that. Now, as far as the overall market, it was a fairly quiet day today. Not a lot going on, but we are still kind of working at this double top range potentially. So we've got the intraday high, which occurred on May 22nd, and we're not quite to that high. So we're at a new closing high, but not a new ultimate high. So we'll see what happens next week. Now, what we've seen in the last few days is a broadening out of breadth. So in other words, not only are you seeing some pretty good buying, you're seeing also breadth spread out. In other words, how many stocks are participating in the rally, how many sectors. It's spreading out, which is very, very healthy. Now, some would believe that it's so healthy that you should rush in there and buy stocks. Others would say it's what's called a blow-off top. And a blow-off top basically means when a stock market is making its last gasp for air. It's taking off, and it's the last burst of energy before it starts falling back down. And what I would say is basically what I said yesterday, which is we're either going to get this little breakout, and if we do and we pull back to this spot, and then we take off from there, that would be a really nice buy spot. But what could happen is that we end up having one of these fake out breakouts, as I call them, where we just break above, we come back in, everybody panics now because it didn't hold, and we get something maybe down here, maybe right here, and it stops, and we make a higher low than we did here, and we go back up. And that would be, all of these are encouraging, but you understand that these are very small moves. Now I moved down to, 16, let's call it 1,600. That's about like a 5% move. So we're not talking about big moves. Are you trying to nickel and dime the market by doing this? Maybe, but 5% is a decent move. But the thing that you're trying to do is not get too cute. So I'm still trying to find ways to buy, not sell. But the market's still very, very stretched in the short run here. And you could see it today because of the fact that these the number of stocks going up versus down was kind of flat today. And so the market may be a little tired in the short run. So again, be cautious, but if you're very, very underinvested, you do need to buy something. Again, caveat being not knowing your situation. That's kind of a general statement. That's not advice to you specifically. But you do want to. Now, if you're somebody that's invested kind of the way you want, but you got a little cash or you want to get more invested, then certainly you either average in with time stops or you wait for some type of little pullback. The thing I really want to talk to you today, and the reason I'm doing another podcast here is I had lunch today with a mutual fund manager. Manages, I believe it's over $1 billion of money, and I'm not going to tell you which fund because it's kind of irrelevant to the story. But it's somebody that has a macro view, and I just wanted to share some of the thoughts and it's kind of what my takeaway was as we were discussing things and kind of had this almost roundtable discussion. There's 4 of us at the table, kind of having this roundtable discussion. And basically, we talked about oil. And this is somebody that, this isn't, unfortunately, this particular system, I'm not showing you my Bloomberg, but this particular system doesn't update oil for a couple of hours after the close. But essentially, with oil was up today, back above 106, okay? So, I asked him, I said, oil at 106, how high can oil go without affecting the economy? And he said, well, let me put it another way. He said that he doesn't think oil can get up to $110 a barrel and stay there and the economy continue to grow and everything feel real comfortable. That would be a definite headwind for our economy, which is what we've been saying here. And then we talked about interest rates. Same deal. How high can interest rates go? And he didn't give me a level there. He's not really an economics guy, but he definitely is very good and is kind of in the trenches in the commodity space and in the bigger global picture. He travels a lot around the world, and he's been all over talking to companies. And what he's seeing is while commodities themselves haven't been doing very well, and we know that commodities have been going straight down, and we talked about the fact, is this deflation, disinflation, what is going on with commodities? He simply says there's an oversupply. China is slowing down, which we know, but what's happening is there's a lot of things on the surface that are benefiting in the commodity space and doing well. So while you may not see a certain commodity going up, there are companies that are benefiting in the commodity space from this, kind of on the fringe there. And so there's a lot of things going well. We talked about trucking companies, which obviously aren't commodities but have a lot to do with commodities. Trucking companies are doing extremely well. A lot of things are happening positively in Mexico right now as labor is becoming competitive on a cost basis compared to China. So if you're an American company, would you rather put your goods and ship them to China on a tanker that's going to take several days to get there, maybe several weeks? I don't know how fast these boats go. But anyways, they look like they're pretty slow when I see them sometimes. Or would you like to truck them down to Mexico and get them there within a couple of days? And that's really what this boils down to, is the cost of moving your products, the cost of getting them into the consumer's hands. So you're seeing a lot of manufacturing move to China, which the U.S. is going to benefit from. So those are some positive things, but there are some things in the commodity space doing well. And the companies that are moving some commodities are benefiting, even though the commodities themselves aren't. So it's kind of a bifurcated market. So that was one thing we talked about. We also talked about Russia and the fact that Russia is a country that he says is to him is still a dangerous place to invest. And while there's great places to invest in some of these emerging markets and countries, Russia he just doesn't believe is one of those. What he is positive on is the development of the middle class. And that's a story literally I've been talking about for longer than I've been doing this podcast, over a decade, about people that are sitting down and they're wanting to eat the way we do. They want to dress the way we do. Maybe not the way I dress, but maybe the way you dress. They want to dress the way most Americans want to dress. They want to listen to the same music. They want to embrace the American culture. And guess what? They're going to do it. No matter what. No matter what recession happens, they're going to do it. And so those people are moving. right? They're moving and from the country to the city. And that development is going to create this big buying opportunity. The question we don't know is, when is it going to happen? When are these things going to turn the corner? And we don't know. That's the big question mark. He doesn't know. And this is a guy that manages well over $1 billion, doesn't know, but we know it's coming. It's like this tidal wave. And so, if there's a couple of areas that I think long term people want to be invested in, it's still the emerging markets. We'll call them the emerging markets, the frontier markets, the places like Colombia, China, Indonesia. Those are supposed to be long term. And also the commodity space, materials, the things that people need for that infrastructure. That is happening. I don't remember what the numbers are, but every few years there's 400 million people moving in from the country to the city. That's a new U.S. being created every few years in these emerging market countries. And so tremendous growth and opportunity, but they are still dependent on what happens in the U.S. There's currency manipulation back and forth, and so you're getting this sell-off. Now, it doesn't mean today is the day to go buy. My point in telling you that is to keep your eye focused way out. How you play that depends on what kind of risk you're willing to take. But this is a bigger macro theme. What some of these managers are doing is they are simply going with what's working sometimes, okay? And they're trying to avoid the areas that aren't. And so there's a lot of momentum-based trading that happens. They're not always contrarian. But another place that they do make money is things that are really contrarian. So, for example, gold miners right now. That would be something that is so far stretched down and has moved so far down so fast that it creates a rubber band effect, and it's a mean reversion trade. So what that means is they're not expecting gold miners necessarily to race up to the moon, but they've been buying things down here hoping that they snap back and have some big meaningful snapback, 20-30% move, okay? And that is what we mean by mean reversion. So there's momentum trading and there's mean reversion. So you get these things that are way extended one way or the other, and you buy those, and you also buy the things that are just working right now. And that's what a lot of these people are doing. And so you can see if a mutual fund manager is doing that, who you always believed was just sitting there buying and holding, which they're not. That's the big takeaway here that I want you to understand, and letting you in kind of behind the scenes. You believe and you are told and you are always preached to that if you buy a mutual fund, you should buy and hold, and with all your investments, you should buy and hold, because that's what the big boys are doing. They're buying and holding. They're sitting there buying and holding, and they own these portfolio stocks, and they're not doing anything. Well, guess what? This is somebody that has a fund that trades options sometimes, shorts when occasionally if it can be, but some managers can't do that. Builds a lot of cash at times, goes and visits companies, constantly doing something. And that's why you see the big banks of Bloomberg machines, and you've seen the people running around with papers, and you see phones on both ears, right? You got a BlackBerry on one, and you got I was going to say rotary phone, but probably not anymore. So maybe they got two cell phones on each ear. I don't know, but they have they have a lot of action going on because they're not buying and holding. And so what's happening is you've got momentum-based trading happening, which trickles down to the markets, which trickles down to your investments. And so everybody's doing the same thing. All the things we've talked about today, I didn't learn anything new today that I didn't already know. It was more a discussion and affirmation. Mutual fund managers are worried about the same things that you worry about. What they're worried about is that we have a stagnant economy. We have some things that are dislocated, meaning correlations that used to be there over time aren't there anymore. For example, commodities. Commodities are going down while interest rates have been going up. Usually commodities and interest rates move together. Okay? You have currencies being manipulated. You have interest rates being held down. You have debt snowballing in all these countries. You have global easing across the board in multiple countries. What does all that look like? And so it's a very difficult market to navigate through. But most people have a very narrow focus on the U.S. stock market because that's where you live. Most people that listen to this podcast, watching this podcast, live in America. And so what you focus on is the S&P 500 here. So you're looking at the S&P 500 and you're saying, market looks pretty good. But when you spread out and look around the world, what's going on, and we went through some of those things the other night about how many things are down considerably this year, take it easy on yourself. Realize that, emerging markets are having a tough time. Gold's having a tough time. Hedge funds are having a tough time. And so when you mix all that together, it's not just the U.S. stock market. This has been the right place to be. If you had it to do over again, putting all your money just in American stocks is the right place to be for 2013. But in the bigger picture, it's not going to be. And knowing when to sell, that people are getting very comfortable right now. And it may be the right trade for a little while longer. I'm not bearish on the S&P at all. But what I'm pointing out is there's some things that are happening behind the scenes that I don't think the average American or average investor it really realizes. There's a lot of complicated things going on, and at some point it's going to break for good or bad. And so, but these mutual fund managers, they're worried about some of this stuff, and they're trying new techniques while they're on the fly. Okay, they're not just sticking to their laurels because they realize that funds flow in, funds flow out. Mutual fund managers have a real big problem when their portfolio goes down and they want to go buy some bargains. Well, guess what? They have to meet redemption requests because you want your money back out of the fund. And so they're not able to do everything they want to do. So you've got some of those issues going on, but at the end of the day, they're making the same decisions on a massive portfolio that you're making on your portfolio and that I'm making on the portfolios that I oversee, which is we look at everything from a big macro perspective, and you're trying to manage the risk versus the reward. And right now, people are taking some risk they don't know they're taking, and they're getting comfortable and they're resting on their laurels. And you go back to 2007, and again, many of you were listening to the podcast back then when we were talking about some of those warning signs, and the market rolled over and had this horrendous sell-off. And I'm not saying that's going to happen now, and in fact, I don't see any signs of that. But I do think fundamentally there's some things that are really interesting going on. In fact, if you take a look at gold right now, there's a reasons why gold's going down. But if you think about it, and you go back to the time when it was going up, 07, prior to the financial crisis, or even 10 or 11, what's going on now with gold? Why was gold going up the last few years? Was it just because there was more commercials on TV trying to sell it to you? I don't think so. I think it was because people saw the debasement of currencies, right? This race to debase. Everybody in the world is debasing. Remember, in 2006 and 7, there was a time back here, I think it was 06, that not one country in the world was in a recession. I remember that. And I was saying that at the time. There's not one country in the world in a recession. Quite odd. Then we come to 08, and there was probably not one country that wasn't in a recession in 2008 and early 09. Okay? But since then, they've printed more money. There's more. Everybody's trying to do it. Everybody's trying to debase their currencies. And so you could argue that gold is even a better deal now than it was back then. And I'm not a gold bug. I own very, very little gold. I'm not sure where gold's going to go. But I think it's just interesting to point out that some of the same things that were happening back 5, 6, 7 years ago, you could argue that they're much worse now. And yet gold has been selling off. And what happens is gold is a lot of people owned gold as kind of their money market for all these years. Every time they didn't have something to do, they bought gold. And we've talked about that with Apple. That was the default for people's money. So when it started falling, this deleveraging process came out where people were buying gold on margin. And now you're seeing that exiting. I think gold's going to get to a point where it starts to bottom and kind of base here a little bit. It doesn't mean it's going to go V-bottom, but I think it should stabilize at some point. And at some point, inflation will kick in. At some point, I don't know when it'll be. It may not be 5 years from now, but at some point, inflation will kick in because this money that's sitting there has to go somewhere. And I want to point that out. You look at interest rates right now, and we talked about this today. This is a misconception to say the Fed is printing money. The Fed initially printed money back when the financial crisis came, and they have printed money over the years. But what's happening right now is, and why we're not seeing inflation, is because think about what happens. The Fed goes and buys bonds, right, from the marketplace. They put the cash in the system, okay? But the cash goes to these traders and it goes to these banks and the people that own the bonds. Then what happens? That cash gets back deposited It's in the bank. It goes back to the Fed and earns 0.25%. So the Fed now has the cash that they just used to buy the bonds. So it's a circle. So the money's the money's in this vortex, but it's not leaving the financial system. It's not being loaned out. It's being deposited back because essentially banks are making very, very good money by doing nothing. And it's all to shore up the bank's balance sheets. And it has done that. I mean, if you look at the financials continue to do well. They've gone through a correction here in the last few weeks, but they've continued to do well overall because they're in much better financial shape than they were 5, 6, 7 years ago. So that's what the buying of the bonds has been helping, and it's been keeping rates low, and it's been causing housing to get better. But until that money starts leaking out of that vortex and comes really into the system, you won't see inflation. But when it does start, you may see too much inflation. And I think that's why the Fed is starting to talk about this taper, because at the end of the day, the tapering may not really do anything. And so that's something we discussed as well. But I just wanted to highlight you on some of the things that we talked about, which was he thinks oil, can it get to 110, 115? It can, sure. But that scares him if it does. On the flip side, the cost of producing the oil has risen in recent years. So he doesn't think it's going to go back down substantially either. So we could be in this range, and we didn't really talk about a floor, but who knows? It may be in the $80 to $105, $110 range, and stay there where it used to go between 70 and 100 perhaps. So those are some takeaways today. But I just wanted to let you in on the fact that this is somebody that is managing a lot of money, and really at the end of the day, not doing a whole bunch different than you do. The only difference they have is having a little more of a mandate of being a little more handcuffed to not be able to go to 100% cash like you and I can. But outside of that, using the same techniques, the same technical signals, all those things that I look at every day, and maybe you do, maybe you don't look at some of this stuff, but there's a lot of technical things that I look at, and they're doing the same things and trying some of those same strategies, and it's a tough market to navigate in, again, unless you're just sitting in American stocks right now, which that's been the place to be. That's been the right thing to do. So, and again, from that bigger perspective here, I think the stock market still looks healthy. I think it's very stretched to the upside, but any little pullback I think still should be bought, and that's what I'm going to be doing, again, unless the data comes out much, much weaker. And what's interesting is when you look at some of the economic reports in aggregate, some of these things are weakening, but are they weakening to the point where the market is suffering? And that's the thing we're going to have to grapple with. Is there's two things to look at. There is the economic data, which in 2007, when we talked about, we were concerned about the stock market rolling over. And when the stock market rolled over here, the economy was weakening at that time. But then you also started to get not a lot of participation in the market. So even though we were reaching new highs, the participation in the market was weakening. That's not what we're seeing now. So even though the economy is weakening, the stock market is not acting the way it did back over here. In fact, it's acting more like it did right in here. It's acting as if it's spreading out and things are getting better. It's acting as if it was the beginning of a bull market, not the end. And that's really important, because if we're going to make money, we have to acknowledge what the market's doing, not what the fundamentals say it should be doing. Okay, that's when we see the economics line up with what investors are doing, then you got something to worry about. But right now, the investors are the one controlling stock prices, not the economy. That will correlate at some point, but it isn't happening right now. So we need to watch that. But you don't ignore the economy, don't get me wrong, but you also take it and you say, okay, I'm going to have exit strategies, but participate on the upside. And I think that's a big deal, because the economy right now is showing some mixed signals, and some things in aggregate are getting weaker. So that's why I keep pointing to interest rates, because I'm pointing to the fact that I don't think they can continue to go up with this economy the way it is. But I hope I'm wrong. I hope the economy re-strengthens, but I don't see that happen. And I see things staying mediocre at best, but that still could be a Goldilocks scenario for stocks. That's the ironic thing, because a weak economy, what does that mean? If it's not too weak but pretty weak, that means the Fed's going to keep doing what they're doing, which, whether I like it or you like it, investors around the world like them buying bonds, and stocks go up. So stocks still are the default place for idle money. It's turning into kind of what we had talked about what gold was several years ago. Okay, don't forget to send me your questions. You can email me all the time. You can post them. You can do whatever you want. You can put them on Twitter. I'll answer them on there if I can. It's at Karl Eggers is the Twitter handle. EggersCapital.com is the money management website. Facebook, Google+, all those places, and iTunes. Don't forget that. Hey, and have a wonderful weekend. We appreciate it. Go do something fun, and be careful this weekend. Thanks a lot, guys. Talk to you soon.